Good morning. Bonjour à toutes et à tous, and thank you all for joining us today. I'd like to extend a warm welcome to everyone who is here in person, as well as those who are watching the webcast of this very special event. I'm honored to have the opportunity to introduce the keynote speaker for this year's John Kuszczak Memorial Lecture. Pierre-Olivier Gourinchas is the Chief Economist and Economic Counselor at the International Monetary Fund. He's also the S.K. and Angela Chan Professor of Global Management at the University of California at Berkeley's Haas School of Business. C'est un privilège de l'avoir avec nous. J'ai hâte d'entendre son point de vue unique sur l'économie mondiale. Throughout his illustrious career, Pierre-Olivier's research has shed light on the international monetary system and the global economy. Among his many noteworthy contributions is the identification of the allocation puzzle, which has helped make us aware of certain patterns of capital flows in a global context. Capital tends to move from poor countries to rich ones. That's exactly the opposite of our intuition, but it happens because financial markets in many emerging economies are dysfunctional. And when people are given the choice, they will hold their savings in jurisdictions that are stable and transparent. Knowing this helps us understand how capital moves through the global economy. Pierre-Olivier's research into global imbalances has also elucidated on the role the United States plays in the global economy. His work showed how the country's gross assets and liabilities allow it to sustainably run a trade deficit of up to 2% without losing any wealth. This unique ability stems from the spread between heavy foreign investment in U.S. treasuries and strong domestic investment in higher-yielding securities. But follow-up research revealed that there is a substantial downside to this structure. It was part of the reason that the United States was hit so hard by the great financial crisis of 2008. Foreign investment in U.S. treasuries effectively positions the United States as the world's banker. And the country absorbed enormous losses simply by paying the promised interest rate on its liabilities. And because the US dollar appreciated in 2008, assets denominated in US dollars had to pay even more in foreign currency. So in good times, being the world's banker gives the United States a unique advantage. But in bad ones, it can mean it pays even more on its liabilities. This is the kind of profound insight into how the global economy works that indelibly imprints itself onto our understanding of macroeconomics. But Pierre-Olivier's impact isn't limited to the articles he's authored. He's also been an editor for a number of major economics journals, including the IMF Economics Review, the Journal of International Economics, and the American Economic Review. In the current economic and geopolitical moment, Pierre-Olivier's insights are especially valuable. After many years of low interest rates, the current tightening cycle has been global in scale. But inflation has been stickier than we originally anticipated, and the labor market has remained stronger. The shifting and at times volatile geopolitical landscape has further clouded the picture. And as we look toward the future, uncertainty is all that's given. And this is exactly why we're so fortunate to have Pierre-Olivier with us to speak about the current and future challenges of the international monetary and financial system. His insights about the global economy will help us better understand the big picture and where we fit within it. C'est pourquoi la présence de Pierre-Olivier est un si grand honneur. Son regard éclairé sur l'économie mondiale va nous aider à comprendre la situation dans son ensemble et le rôle du Canada. La présence de Pierre-Olivier aujourd'hui est un très grand honneur. Sans plus tarder, je passe la parole au professeur Pierre-Olivier Gourinchas.
Well, thank you very much, Sharon, for these very kind words. Merci beaucoup. C'est aussi un plaisir et un honneur d'être ici aujourd'hui. It's a pleasure and an honor to be here today. I will give a talk that will be about what I called Current and Future Challenges for the International Monetary System. I won't be talking too much about conjunctural things like monetary policy or the current fight against inflation. I'll take sort of a higher perspective, but I think we have a number of challenges we have to face. I should start, the usual disclaimers at the bottom of this slide. The views I'm presenting today are my own. They are not representing the views of the IMF, its executive board, or IMF management. So when we think about the international monetary system, what do we have in mind? Well, in part, we have in mind the institutions that have been put in place after the Second World War, the Bretton Woods institutions. And these institutions were founded on a double proposition to ensure mutual prosperity and peace. One was that there would be free trade under WTO rules. The World Trade Organization would be setting sort of the rules of the road here. An important component of that is to have current account convertibility so that countries can really trade goods and services as freely as possible. And then on top of that, the IMF would be there to help countries manage temporary external imbalances, balance of payment disturbances, initially in the context of the Bretton Woods system, fixed but adjustable exchange rates, but then that system evolved. Now, we had, following the these institutions' creation, we had a tremendous explosion in global trade first, and then later on in financial cross-border transactions. So here I'm plotting trade openness from 1870 to 2021. The part I'm more interested in is what you see after 1944, 1945, what is called the Bretton Woods era, where we already see some increase in trade flows, but that's mostly recovering from really the collapse we had in the interwar period. And then after 1980, we have really an acceleration of this trade integration that ends around the time of the global financial crisis of 2008. And you can see that the last period, which is labeled globalization here, is one where trade integration doesn't really decline much, but has certainly not increased very much. Now, that second period of liberalization here from 1980 to 2008 is also associated with very significant increase in cross-border financial transactions. Now, the system really changed dramatically during that period. Bretton Woods system actually ended before 1980, in 1973, when the dollar went off the peg with gold and currencies started floating against each other. And so you have had many transformations along the way, but the general architecture remained somewhat unchanged in ways that I will characterize. So in this lecture, what I want to take stock of is how the system has changed or not, and what are the challenges that lie ahead. Now, one of the very important ways in which the system has not changed that much is the importance of the US dollar as at the center of the international financial and monetary system, and also at the center of international trade. Now, here on the slide, I'm reporting metrics that you may have seen because a number of, the ECB publishes something similar to that. This is a graph that's taken from a staff discussion note that we put out last January on geoeconomic fragmentation. And you can see different metrics, the importance of the US dollar in foreign exchange reserves on the left, in international debt, international loans, foreign exchange turnover with data coming from the BIS, or in the global payment system, so data coming from SWIFT. Really, the picture that emerges from that is the dominance of the US dollar. Even as we moved from a system where the dollar was effectively at the center, the Bretton Woods system, most currencies were pegged to the US dollar, and the US dollar was pegged to gold. After that, currencies were floating. Nevertheless, the dollar remained really very much at the center. I'm not showing you numbers on this, but we all know that the same dominance is there when we're looking at currency invoicing. So in the space of international trade, if Brazilian firms exporting to Korea, chances are that is going to be invoiced in US dollars and not in Brazilian reals or Korean wons. Now, this dollar dominance rests on a set of interlocking features that are reinforcing each other. In invoicing trade, I've mentioned debt issuance that you can see on the slide, reserve accumulation, and even exchange rate policy. And what do I say mutually reinforcing? Well, because the more trade is invoiced in US dollars, the more firms are going to want to hedge that currency exposure, and so there's going to be a desire to issue debt in dollars as well. The more dollar debt is issued, then the more there's going to be a need to manage the dollar exchange rate for the individual countries, and the more you need to manage your dollar exchange rates, the more you need to hold dollar reserves to be able to do that, and the more dollar reserves you have, then the easier it is for firms to start also invoicing in US dollars when they're doing trades. So all of these features are reinforcing each other, and here let me show you a figure from a recent paper by Mitalidas Gita-Gopinath, the first deputy managing director at the fund, and Jeremy Stein and other co-authors, that plots the average non-financial corporations' dollar liabilities as a percent of GDP. That's what you have on the horizontal axis, and on the vertical axis, the dollar reserves by the countries. And you can see a positive correlation between how much dollar issuance by non-financial corporations you have in a country and how much that central bank is holding dollar reserves. So what that means is also there's going to be a need for the provision of dollar liquidity in times of crisis. And this is where what we call at the fund the global financial safety net comes in. And that's going to be one of the things I want to talk about today. So when we look at the global financial safety net, it has a number of layers. So again, the global financial safety net in the sense of the set of resources that are available to provide liquidity to countries in times of stress. At the bottom, what you see on this figure, the last two bars in green, are IMF resources. The solid green, this is the quotas. So that's if you want to think about it as the capital that the IMF has and it can deploy by lending to countries. The shaded green are IMF borrowed resources, which are conditional agreements it has with a number of countries and currencies to provide additional resources. Then on top of that, you have additional layers that can provide liquidity to countries, regional financing agreements, bilateral swap lines that can be limited, or some of them between advanced economies can even be unlimited. You put all of these things together and you come to something that is of the order of about 5.5% of global GDP. There is another layer of the global financial safety net. That's the red line that you see there, and that's on the right axis on this figure, and that's accumulation of international reserves. And that is much larger in size compared to all these other layers I've already mentioned. We're talking about 15%, close to 15% of global GDP. So the way the international monetary system and financial system is operating right now is with a number of these layers that provide liquidity, but they're relatively small overall. I mean, the fund itself, the resources coming from the fund, add up to something that is of the order of 0.7% of world GDP, both quotas and borrowed resources, while the overall resources available are closer to 20% of world GDP, and most of this is in the form of reserves. Now, there's been a lot of discussions recently. We're towards the sort of the final leg of what is called our quota review at the fund, and a lot of the discussions around this quota review are about increasing the quota resources of the fund rather than relying on these borrowed resources. And so discussions are underway. Things are looking relatively good, but we'll see where they land exactly in a couple of months' time. So now, a system that is relying on reserves, that means relying on self-insurance as opposed to contingent provision of liquidity that you could obtain from other countries. That's going to suffer from a number of issues that are well known in the discussions that I see in the room. Many people who have actually written on these questions, and I think these are very important issues that need to be thought about. One is that, of course, reserves are very unequally distributed. About 10 countries hold about 2/3 of these reserves that I showed you there. Very large number of countries, when you add them up all together, account for a very, very tiny fraction. So a lot of countries don't have much self-insurance to start with. The only layer that is really available to all countries in proportion to their size is really the IMF through its lending tools. But as you could see from the previous chart, it's relatively limited. Now, what are the problems with a system that is reliant on reserves or self-insurance? Is that it's a poor substitute for provision of contingent liquidity. And here I can think of two particular reasons why this is somewhat inefficient. In addition to being costly, I mean, one thing that has been identified in literature for a long time is the fact that there is a quasi-fiscal cost in holding treasuries that pay relatively little, as opposed to investing in your own country. And one is what I would call the global precautionary externality, something that Federica Romay has done work on with Luca Fornaro. If the issue is that you're trying to self-insure against aggregate shocks, then every country trying to do that is going to depress global safe interest rates, could be enough to push the global economy into a zero lower bound type situation, in which case you would have the realization of the global recessions that you're trying to individually and rationally self-insure against. So the very act of everyone trying to self-insure could precipitate the kind of outcome that you're trying to avoid collectively. So that's a global precautionary externality. Another externality is related to discussions around the original sin, the fact that if you have a larger reserve accumulation, you may encourage, among one of these interlocking steps I mentioned earlier, your non-financial sector to borrow more in foreign currency because they know that the country has more reserves to maybe deal with a liquidity shortage. But that in turn tends to also propagate sort of the cost of insurance to other countries. And so this is something that, again, this paper by Mitali Das, Gita Gopinath, and Jeremy Stein touches on. Another point that has been mentioned in this literature is the growing asymmetry between the safe asset providers and the rest of the world. I mentioned that the dollar is at the center, so somehow what is key here is dollar liquidity and dollar provision, and that means that there is to be a sufficient supply of dollar safe assets. And the question is, if the rest of the world is growing faster than the US, as we hope that it will, as emerging market and developing economies are catching up and becoming more developed along the way, then there's a question of whether the US can keep providing this type of safe assets. And that goes back to an old discussion in this literature, an old debate between what I would call the Triffin versus Kindleberger views of the world. Robert Triffin was an economist at Yale University, did a lot of work together with the IMF. Charlie Kindleberger was, of course, economic historian at Harvard. And there are two different ways of looking, and this is back in the 1950s and 60s, two different ways of looking at the system as it was then that still carry a lot of relevance for the way we think about the system today. What Triffin was arguing back in the 60s is that the system was unstable. At the time, the US dollar was pegged to gold, and Triffin was arguing the system is going to be unstable because the world economy is growing faster than the US, so the demand for reserves is growing. Countries can hold reserves in the form of US dollars. They expect them to be pegged to gold, so they expect that the US is going to be able to deliver gold if needed. But of course, the supply of gold was fixed. And eventually, there would be a point at which the liabilities of the US in the form of safe assets would not be backed by their holdings of gold, and there would be a run. Now, he proved right in that part of the collapse of the Bretton Woods system was a run on the US dollar, on the anticipation that the peg to gold could not be maintained. There is a modern version of this Triffin dilemma that has been articulated by people like Barry Eichengreen, Maury Obstfeld have done some work on this with Emmanuel Fari and Ellen Ray, where we translate this argument in the current environment by saying, look, the US is providing the global safe asset in the form of US treasuries. The world economy is growing faster than the US. The demand for safe asset is growing alongside the global economy. At some point, the demand for safe assets may outstrip the capacity of the US economy to backstop the value of its own public debt, and then you might get what is called to a Triffin moment. That was subsequently formalized in a very nice paper by Emmanuel Fauri and Matteo Maggiore in the QJ in 2018. Now, the opposite view is Charles Kindleberger saying, no, in fact, what's going on here, and that's in a sense a view that my own work has been associated with, and Sharon mentioned it earlier, is that the US is providing some insurance functions to the rest of the world, and that's a helpful arrangement, and it's earning maybe some premium along the way, but in doing so, it helps to stabilize the global economy. So that Kindleberger versus Triffin debate, I think, is still going on as we look forward, and I will come back to it in a minute. Now, one thing that I've done many times over the years is to try to measure the extent to which the US is earning an excess return on its net external position, in part because it is providing some of these insurance and liquidity services. Now, the data on this, when we started with Ellen Ray working on this, we used balance of payments data, international investment position data. Data was very top-down, was very fragmentary. We had to make a lot of assumptions. We had to make a lot of imputation to try to get at estimates of the excess returns. And subsequently, many other people have revisited that question. Now, in the recent work I've been doing with Carol Berthaud and Stephanie Kokuru and Esther Faya, and Carol and Stephanie are at the Fed, so we can use the securities level data on the US net external position, so we can see exactly security by security what is being held by foreigners and what US investors are holding abroad through the reports of the custodian banks. So we've been able to construct estimates of these returns, and here these are estimates from 2005 to 2020 using the securities level data. And so here this table is showing you that the first column is our estimates, which we consider to be the definitive estimates because they're not relying on imputation. We actually measure everything that there is to measure there. And we do confirm that there is a significant excess return on assets relative to liabilities for the US. The claims return is about 8%. The liabilities return is about 6%. The difference is about 1.8% per year. Now, interestingly, this is not too different from what you would have if you were to do the calculation using BA data, sort of the top-down approaches that require that you make a little bit more assumptions about what's going on, but it would range from 1.8 to 2.6, so a little bit higher estimates, but not substantially different. Now, when you break it down into returns on equity and debt, and by the way, these are here, I'm only reporting returns on the portfolio part. The securities level is only about the equity and the debt. So this does not include direct investment. This does not include bank loans. This doesn't include trade credit or other forms of cross-border claims. So this is just the portfolio part. When you break it down by type of assets and between equities and bond returns, you find a number of interesting things here, and I want to sort of flag a number of them out. So first, here on this table, I'm breaking it down in different sub-periods, just to show you that there is an enormous amount of volatility over short periods of time. The total return differential can be 5% per year over that 4-year period, can turn to negative 2%, et cetera. So that 1.8% is really when you average over relatively long periods of time, but you can get a lot of volatility. The second point is there isn't really much difference when you look at the return on equities claims versus equities liabilities. 9.3 on equity claims, 9.7, of course, these are all dollar returns, so we're comparing apples to apples. 9.7 return on liabilities, very, very similar, slight difference here. The big difference is really between the return on equities and the return on bonds. And so some of this excess return that you see there is really coming from a composition, the fact that the US is holding a lot more equities, which we have known for a while, and is issuing a lot more, and a lot more of its liabilities are in the form of debt. And among this, notice also that within the debt, there is a difference in returns of about 70 basis points here between the debt claims and the debt liabilities. And that also reflects that these are broad categories here. A lot of these things might be US treasuries or agencies. A lot of these things here might be risky bonds that are held by US investors abroad, and therefore are also earning a part of a risk premium. So the bottom picture here that emerges is it's really about beta, it's not about alpha. It's really the composition of the portfolio that translates into a higher return because the US investor on that is taking a riskier position than the rest of the world, and that's reflected in these excess returns. Okay? So that's something that we kind of knew, but here I'm sort of showing you things that are measured in, with the most accurate and the most precise data to date. One of the things we can do with this also is we can revisit what happened to this excess return in more recent times. Again, this excess return was very, very large in recent years, and then it sort of seemed to wane away. Some people have been writing papers about the end of the exorbitant privilege, for instance. And here, what I'm showing you on this figure is that there has been indeed some erosion of this excess return. So here, what I'm showing you more specifically is the cumulative valuation, net valuation component on portfolio equity, which is where most of the action has been, starting in 2002 and going all the way to 2021. Now, the green line is using the securities level data. The bluish kind of line is showing you what you obtain if you use the BEA published data. Now, the BEA relies on the TIC securities level data, but they release it at different times for the claims and liabilities, or do a number of imputations, so they are not exactly aligned, and so we can compare the two. And the point I want to make here is that you can see how the cumulative valuation, which is part of the equity, net equity return, and you would expect to be positive, was positive, but has been eroded in recent times. Now, a lot of people have been writing about that particular decline starting in 2015 in the BEA data. But when you actually look at the TIC portfolio equity data, you realize this started kind of earlier, and in recent years may even have stabilized a little bit. So there is a story about excess return on holders of US equity in recent years relative to foreign equity. That is interesting. Again, it might be just a fluke, the realization of some shocks. I wouldn't put too much weight on this, but I just wanted to show you that the kind of data we have can help us speak to that. More interesting, in my view, is the fact that we can also, using the securities level data, we can map the flows that we see, the cross-border flows, we can map them back to characteristics of the underlying firms. So what I'm showing you here is a mapping between firm-level TFP on the horizontal axis for US firms on the left, so those are liabilities from the US perspective, and foreign firms on the right. And on the vertical axis, I'm showing you the portfolio share that we see in the TIC data relative to the market cap. So in a sense, this is the directional investment of foreign investors relative to the market size. So if we see a positive number here, it means that the foreign investors are holding a higher share of this particular firm than represented by its market cap. If they were investing basically according to a broad index, they would be at zero for all their investment. So above, it means they're tilting their portfolio in that direction and away from the negative. And what do you see when we map against the TFP at the firm level is this very clear, very strong, very tightly estimated relationship between TFP and the portfolio share relative to market cap. So in other words, cross-border investment allocates to the top. It goes to the firms that have the highest TFP. Now, it's not only for foreign investors coming into the US, but the same is true for when you look at US investors investing abroad. Again, these are firm-level TFP, and again, you see this allocation to the top. They have a higher share in their portfolio for firms that are measured to have a higher TFP, where we measure TFP using the standard techniques. We do it a couple different ways, actually, in our paper. Another dimension that is very interesting to us is if we look at the link between markups and cross-border portfolio allocation. Now, this one is harder to interpret. I mean, the one that I showed you before, the TFP, suggests that there could be something allocative about cross-border investment that helps improve. If you channel more resources to the more productive firms, that kind of suggests it's a good thing. Here, I'm showing the same thing is true if you look at markup on the horizontal axis, and again, this portfolio share corrected from market cap on the vertical axis. Cross-border investment, both US firms held by foreign investors, foreign firms held by US investors, tend to go towards firms that have higher markup. Now, this is a bit harder to interpret because, as you know from the literature on estimating markup and interpreting markup, if you compare sort of the Mellitz view of the world versus the Philippon view of the world, high markups could be suggesting that there is somehow firms are too small, there are maybe some frictions that are preventing them from being at the optimal size. And so again, that would be suggesting that maybe this allocation to the top is helping overall allocative efficiency if those firms were to expand in size, for instance. But it could also be suggestive of market power, in which case it would not be generating additional efficiency gains. And that's something that we're investigating right now. I don't have answers to provide on this particular point. So the bottom line here is that we do see evidence of excess returns. That's the Kindleberger view, if you want. We do see evidence that these cross-border flows, they are not random, and they are not just based on market size and characteristics. We look in the paper, we look at betas, we look at intangible capital, we look at a number of measures, and we always see this pattern where they tend to allocate towards the top. So what about the Triffin view? And so for the Triffin view, again, the argument that the system will become unstable because the US, as a provider of safe asset, will become too small to really provide that safe asset without endangering its own fiscal position, that there is a limit to how much debt it can issue. It has to be backed by the size of the economy and the revenue mobilization. And you could have some questions about that even for the US. So let's start by looking at the relative size. And so here I'm plotting according to our WEO estimates, the relative size of advanced versus emerging market economies going all the way to 2028. This is the end of our projection horizon for the World Economic Outlook. And you do see very clearly that period of, very rapid, especially after 2000, very rapid financial integration, trade integration is one where we've had rapid growth in the relative size of emerging market economies relative to advanced economies. So that sort of speaks to maybe this is becoming a little bit less stable. But notice also how after the global financial crisis, in other words, the period during which we had this plateauing of globalization, you also have a plateauing in terms of the relative shares. Now, the relative shares here are done with current income, gross domestic products at current prices in US dollars. So this is not correcting for PPP or anything like that, which is the relevant way to think about the provision of safe assets. You want to think about the dollar value of the dollar safe assets relative to the dollar value of the world GDP, okay? So that here is something that we've been trying to think a lot about at the fund recently, which is, this slowdown in this convergence is not good news. And we see it when we look at this 5-year ahead projections. We see that if we go to older vintages of the World Economic Outlook and we look at what the projection for 5-year ahead growth was back in 2008 for 2013, it was around 5% for the world economy, 7% for emerging market economies, and 3% for advanced economies. And notice how in different vintages, coming all the way to the 2023 vintage, forecasting growth for 2028, this has been marching down tremendously. So the prospects for growth are much, much lower. And you might say if all of them go down, then it's, doesn't necessarily mean that, the rest of the world is still growing faster, so they should still be catching up. But in fact, what you see on the right is if you do a simple growth regression, again, using the log real GDP we do it for 2008 and 2023 on the horizontal axis and the growth rate on the vertical axis, notice how the slope has decreased, meaning slower convergence, and the whole curve has shifted down, meaning lower growth for everyone. Okay, so we have a world that is not converging or growing as much as it used to. And if we unpack this a little bit more, and I've showed you advanced economies and emerging market economies, but if I unpack this a little bit more, and now I break down the advanced economies into the US, the euro area, and other advanced economies, and I break down the emerging market and developing economies into China, other BRIC countries, so I guess it would be the BIC country or the BRI country, and then the rest of the world, you also see some interesting patterns. One very interesting thing is if you look at the US, again, this is not adjusting for exchange rate movements, but exchange rate movements are part of this story. It's not clear that there's been any decline in the size of the US economy, at least since, the 1990s. Okay, it's about at 25%, and it was at about 25%. So a lot of the decline in advanced economies that were seen in the previous graph, this is mostly euro area and other advanced economies. Now, of course, we have seen the rise in China. For instance, you can see that after China's joining the WTO, you see this very rapid turbocharged growth. But notice how this also plateaus out. So looking forward, the growth prospects for China and for some of the other emerging market economies are also a little bit dimmer. And so what I would take from this is the Triffin view is eventually going to be right, but it may be less of an immediate challenge to the existing international monetary system than one might think. Okay, so now let me talk about new challenges, and I want to talk about three things. First one is going to be very related to the first paper we saw this morning by Dima and the discussion by Emine on managing capital flows, and I want to talk about living in an era of high public debt, and then I want to end with geoeconomic fragmentation. All right, so on the managing capital flows, I can go quickly on this because I think this was already mentioned earlier. We at the fund have done a lot of work on trying to think about situations where you can go beyond just using your monetary and fiscal policy, setting your policy rate or your fiscal stance to deal with capital flow movements. And what we call our institutional view, which is building in part on the work that Emine and Gita and others have done at the fund, Suman Basu, on the integrated policy framework, recognizes that FX interventions or capital flow management measures have a role to play, quote unquote, under the right circumstances. And some of these circumstances are outlined in the bottom part of the slide. If your FX market is shallow, so small order flow movements are going to have a very large impact on prices. If you have maturity mismatches that could threaten financial stability, or if you have situations of very high pass-through, unincurred inflation expectations, and large movements in the exchange rate could really derail your inflation stabilization efforts. So what I want to do is I want to take some of this, and I want to show you how I can try to answer Felipe's question earlier, which is, well, can we think about simple rules and can we think about simple metrics that could help us think about when and how we want to intervene, for instance, in FX markets, or we want to set up capital flow management. I'm going to show this in a very simplified setup that is not going to capture a lot of the issues that are relevant. There are many other things, but I want to, in that very simplified environment, I want to show what message we can get. And then I want to talk about empirically how we could go about implementing that. So I'm going to present very quickly a simple model of what I call basis control. And the basic idea here is that there are two literatures that have been somehow looking at the same problem from a different angle. One literature has been the literature in international finance that Adrien and Wang Xindu and others have been making big contributions to, that looks at CIP deviations. And then there is another literature, more theoretical literature, related to the work of Javier Bianchi and Anton Korinek and others, that identifies wedges that are relevant for optimal policy. And it turns out that under the right simplifying assumptions, the wedge and the CIP deviation are kind of the same thing. I should be clear that I'm not going to be talking about, unlike the first paper you saw this morning, I'm not going to be talking about UIP. UIP is a more complex object in my view because it also reflects equilibrium response to risk pricing that are difficult to maybe sort out from the inefficiency part, while CIP is a much cleaner conceptual interpretation. You're seeing a riskless arbitrage, and it's not being arbitraged away. Something must stand in the way. So what is that something, and does it matter? So here I'm showing you a very simple setup. Imagine you have a small open economy. It's producing, it has an endowment of traded goods. It produces non-traded goods, very similar to the papers we saw earlier today. I'm going to take the limit where the discount factor is 1, so you're perfectly patient. It's a simplified version of a model that Javier and Guido Lorenzoni have in the Handbook of International Economics. And you can think of the demand for dollars that this small open economy has, and it needs to obtain these dollars, it needs to obtain them from foreign intermediaries. I call it mu, but it was gamma in the earlier versions here. It's exogenous. I'm not going to, and it has a little t there because it could change over time. And what is xt? Well, xt is the compensation you need to give to these foreign intermediaries for them to be willing to provide these dollars. And so what is that compensation? Well, that's where the CIP deviation comes in. It's going to be the opposite of the basis typically measured. So that would be the local interest rate swap into dollars minus the dollar rate. So this is how much the intermediary earns minus its cost of funds. So this is what they're going to be willing to offer more if they're compensated more. And here it's linear. And now, why does this small open economy country need dollars? Well, they want dollars because they want to smooth consumption over time. And here's their intertemporal, borrowing demand. You can see that if resources discounted back to today are equal to today's resources, they wouldn't want to borrow or lend. They would just consume what they have. But if they have more resources coming tomorrow, then they want to borrow today because they want to smooth consumption. Okay, so it's very simple. And this XT is reflecting the cost for them of accessing these dollars. This is how much they have to pay for them. So you have two equations, the supply of dollars, the demand for dollars. You can solve that, and you get an expression for your CIP basis, or the opposite of the CIP basis, or how much dollars you borrow and how much you would consume. Okay, so it's a very simple model. You can represent it graphically. So here is my supply of dollars, here's my demand of dollars, and you have an equilibrium where the spread, the CIP basis, and how much dollars you borrow is determined. Now what happens if all of a sudden the suppliers, these intermediaries, decide that they don't want to offer you dollars? So that's a decline in this mu t. That's this intermediation capacity coming down. Well, that supply of dollars sort of rotates up. They will offer fewer dollars and at a higher price. Okay? Now, this here is where typically in this kind of models, you could have some externality. Okay, why do you have an externality? Well, because now you don't have enough dollars, so now you're going to have to cut down consumption. But you cut down consumption, maybe you're going to cut down consumption of the non-traded good. Remember, the non-traded good is produced at home, so maybe you will have a recession at home. Now, if prices were flexible, then the price of the non-traded good, the local wage, all of this would adjust. You wouldn't have a recession. If the exchange rate can depreciate, making the foreign good very expensive, again, that would boost the demand for the non-traded good. You wouldn't have a recession. But there are situations where these things cannot happen. Maybe your exchange rate cannot depreciate all the way. Maybe your wages are sticky, and then you have an inefficient recession. So what can you do in that situation? Well, if you're a planner and you solve the planner's problem, you're going to have, so these are the same curves as before in black. You're going to have two situations, a situation where you don't have a recession and a situation where you have a recession. If you don't have a recession, what the planner is going to want to do is going to want to correct what is called the terms of trade externality. What is the terms of trade externality? Is that it realizes that you have to borrow these dollars, and if you borrow a lot of them, it's expensive, so it's going to try to exploit that and reduce the amount of dollars it borrows in normal times. That's a standard result, nothing new there. So if you have, in general, you want to be at point B rather than point A, and if you have a tightening of financial conditions, you'll move to B prime. And notice that at B prime, you're still borrowing less, but you're also facing a much lower spread, a much lower basis. So if you avoid a recession, then the rule is kind of, you want to constrain your basis. If you hit the recession, actually the opposite can happen. At that point, maybe the planner wants you to borrow more. Well, because borrowing more allows you to support your non-traded sector. And so you see that at that point, you borrow more and you pay more for it, but it's actually optimal. So you can translate these things into an optimal policy rule. And this optimal policy rule will be something that is very, very complex. You know, you can have like a tax on capital inflows or how much you borrow in dollars that you can express as a function of the state of the world today, the expectation of the state of the world tomorrow, whether you have a recession or not. In this simple model, it's a very, very simple expression for this. This is basically telling you want to have a positive tax in normal times when you're outside of a recession, and you want to have a subsidy when you're in a recession. You want to encourage foreign borrowing. You could do the same thing using FX interventions rather than capital flow management. I'm hopefully behind, but I will try to catch up. So you can do the same thing with FX intervention. And FX interventions are not optimal generically because there's this quasi-fiscal cost. In order to have FX to spend, you need to accumulate it in the first place, and that's going to be costly. What you can do is, and you see a lot of central banks doing that, is using forward FX interventions that don't require immobilizing reserves in the first place. And again, that will bring you closer to the optimum. Now, why do I want to show you all this? Well, because I told you that, in a sense, this basis, this X, which is a measure of this friction, is, in that simple model, is kind of a sufficient statistic for policy intervention. So how about we go and measure it? A lot of work has been done on CIP deviations in advanced economies. And again, this sort of the definitive work is in part of the very influential work has been written by Adrien and others. But there's relatively little on emerging market CIP deviations. Now, a lot of what I was talking about is really relevant for emerging markets where you're going to have this issue of how deep your foreign exchange market is. This mu T here is not particularly relevant if you look at the euro dollar or the yen dollar. But if you look at the Mexican dollar, Mexican peso, US dollar, that's going to be more relevant. Now, an issue with measuring CIP for emerging markets is, think about the home leg of the CIP deviation. It's the return on a local government bond. That is not risk-free. There's credit risk there, so you need to control for that. So what I've done in some work with my DAO at the fund is to do just that. And what we do is, I'm going to get to that in a minute, we use the issuance of bonds by supranationals, the European Investment Bank, the International Financial Corporations, the World Bank, the European Commission, the KfW. These supranationals, which most often have full guarantees from their shareholders, issue in multiple currencies, including emerging market currencies. So we can construct a CIP deviation using the bonds that have been issued by these entities. And that CIP deviation is going to be cleaned from any credit risk at the country level. I'm going to skip a couple of slides here. They're on a sort of a simple portfolio model to show you what are the drivers of the CIP deviations in general. Oops, sorry, in the interest of time. We have a little model where you have an intermediary that can invest risk-free in home or foreign currency that is hedged, can offer forward dollars. And the expression for the CIP deviation, so this is the dollar rate, this is the local currency rate, this is the forward premium, the forward rate over the spot rate, -1, so this is your return, is going to be determined by the sign of the forward position that the intermediary has to take. The intuition is very simple. If the intermediary has to sell you dollars, that's the FT star positive, then those dollars are going to be expensive. And the CIP basis here is going to be positive. If the foreign intermediary has to buy dollars, well, it's going to buy them cheap. The forward rate is going to be low. And then the CIP basis is going to be negative. Now, if the foreign intermediary is buying dollars, okay, that means that the country is selling dollars. And so that's a situation where a country would be long dollars. They need to sell dollars forward. And vice versa when FT has the other sign. So basically this expression, very simple expression, tells you that the sign of the CIP deviation and its fluctuations over time should reflect whether the country is net dollar long or net dollar short. Do we see that relationship in the data? And when we look at advanced economies, The answer is definitely yes. So for 3 months LIBOR basis, 3 months government basis, advanced economies, against the measure of whether they're long or short in dollars, it lines up very, very well. What about emerging markets? No, doesn't work at all. Why? Well, I'm going to claim that because these measures of the basis are polluted by credit risk. So once I clean the CIP basis from this credit risk using the supras, I get the blue line here for Brazil, and the blue line for Turkey. Red is the conventional naive CIP, LIBOR or government bonds at, this is for, I believe, the 1 year. And the gray lines are different CIPs that you can construct with different supras. You know, different supras are issuing in a given currency. And the blue is sort of a common time fixed effect that we have there. I'm going to take 3 more minutes if I can. Once you do that, actually, let me come back to this and emphasize something for a minute here, if I can. There we go. Notice how the CIP is much smaller, how it is shifted up, so now countries can be positive or negative, and much less volatile than the naive one. You can see that for Turkey here, that introduced a number of restrictions on forward transactions after 2019, and our estimated measure is much smoother. So once we do that, this is the naive CIP, no relation with your dollar long exposure. This is the corrected one, okay? It lines up perfectly. Moreover, when we look, that's a regression that shows the same thing. Moreover, when we do, if you go back to this expression here, notice that we have a bunch of variables here that capture, for instance, whether the country has policy instruments that are trying to improve the depth of the market. So here we can look at liquidity regulation in the home country, we can look at liquidity regulation in the US, or we can look at capital flow management. And this triple interaction here, so this is measure of stress in the market, a measure of net dollar exposure, and the policy intervention, is very strong and has the right sign when you look at liquidity measures in the US. Of course, that's not surprising. These are the global financial intermediaries, or when you have capital flow management measures. Subsequent work that we're doing with, again, Maidao and Rimano and Naoki Yago is looking at the impact of FX interventions. We have daily data for Brazil on FX intervention. Most of these interventions are on the forward market, and they kind of work the way you'd expect, which is every time there's a forward sell, dollar sell, it tends to widen the CIP deviation when it's already negative. So all of this to say that this is a research agenda that I think going forward is going to be helpful in trying to tie in, going back to what Felipe had mentioned, how do we think about writing simple rules where countries should be intervening on the markets? What we're seeing in Brazil is already a form of CIP targeting. Their FX interventions are narrowing the range of fluctuations of the CIP deviation. When it becomes too negative, they start doing forward purchases. When it becomes too positive, they start doing forward sales, exactly stabilizing the CIP deviation. And that's kind of what we would expect. Now, there are a couple other things I would like to talk about. I'm going to mention them very, very briefly if I can, because I want to leave some time for questions. I mentioned there are 2 other issues. Living in an era of high public debt. I think here, not unrelated to the questions of basis trade, because a lot of these plumbing issues, for instance, in US Treasuries are related to investors taking advantage of the forward trade on the Treasury market versus the cash trade. We have issues, and that's related to this Triffin question, of how increased issuance of US debt can be absorbed in a way that doesn't lead to a market that starts dysfunctioning. And I think this is something that we are increasingly worried about when we look at the way the market has been behaving. You can see that when you look at metrics for Treasury liquidity that is deteriorating. You can see that when you look at measures of volatility in the bond market, in the US bond market, that is also deteriorating and is reaching levels that we have seen back in March 2020 at the time of the dash for cash. So there are signs of strain in this market. And the Triffin moment is not just about growth. it's about how much debt you issue. And here, this is the CBO projection for US federal debt held by the market going forward under current policies to 2053. And you can see that that could be a problem. Final, very challenging issue in front of us, rising geoeconomic fragmentation. And here, I think this is really an issue that is front and center in the policy discussions we're having at the fund. We're seeing rising fragmentation when we're looking at commodity trade. We had a whole chapter in our World Economic Outlook. We see a surge in trade restriction measures in commodity space. Commodities are very concentrated, so that can be very disruptive. And we estimate very significant impact on, for instance, something like the green transition that requires critical minerals, that requires rare earth and things like that to be implemented. We see, I'm going to skip that one. We see fragmentation when we look at direct investment across countries. We've done a lot of work on this back in our April 2023 WEO. The graph that to me is the most interesting is this one, which shows that geopolitical distance, when you are running something like a gravity regression for bilateral direct investment, geopolitical distance is a stronger determinant of direct investment than geographical distance. So countries trade more in terms of direct investment, invest more and more in countries that are aligned geopolitically rather than closed geographically. And finally, with all of this, it's not like we're seeing the world breaking apart into different blocks yet. And this chart here is showing what I think is quite interesting and very relevant, which is we see less trade between the US and China. So we see less imports between US and China and less exports between US and China. But what we do see also is more export from China to countries like Vietnam and Mexico, and more imports from the US from countries like Vietnam and Mexico. So what you're seeing is more of an elongation of the trade matrix rather than a separation. We see the same thing when we look at capital flows. I will skip this one. This is just global imbalances. We have, with the surge in energy prices last year, energy producers have generated large current account surpluses. Past episodes of current account surpluses have been associated with increased reserves. This is what you see in gray here. FX reserves. Look in, somehow we lost the years are here. 2003 to 2009, we had high oil prices, high accumulation of reserves. High energy prices in 2021, 2022, we don't see accumulation of reserves. What do we see? Other investment. What is that? A lot of it is likely to be opaque accumulation of reserves through, again, an elongation of this time, not the trade flows, but the financial flows going through intermediaries. It may not result in a lower demand for dollar reserves, but certainly a way that maybe is harder to trace. Certainly something that we're looking at very closely. So let me just skip the last 2 slides and conclude because I'm way out of time. The international monetary system has been resilient so far, but it will be tested further by geoeconomic fragmentation, rising debt. And even if we can make progress on the IPF and we can make progress on how countries should deploy the reserves they have and the instruments they have, relying on self-insurance is likely to be insufficient. And we will need to think about ways to buttress the system, make it more multipolar, maybe make it more less reliant on just US dollar assets as sort of the cornerstone, and have institutions like the IMF be sufficiently funded and resourced at the center. Thank you.
Merci beaucoup. Nous avons assez de temps pour quelques questions. So if you would like to make a question, please raise your hand. I will call on you and then state your name and affiliation. If there is anyone online who would like to ask a question, you can just type it into the chat. I'm monitoring that.
Hi, Amy Huber from Wharton. You mentioned forces that could bring the Triffin moment closer, for example, the U.S. fiscal capacity, and factors that could moderate the approach of the Triffin moment, for example, the compression in world growth. I think in thinking about when the Triffin moment will arrive, it's also important to understand that foreigners' demand for U.S. Treasury encompasses two separate demands. One is for safety, which only the US government can provide. The other one is actually just exposure to dollar. And from that perspective, actually in a research that I'll hopefully present this afternoon, we show that actually foreigners are quite amenable to dollar debt issued by non-US residents. And so from that perspective, we can think of the capacity to generate dollar-denominated assets as broader than what the US government could provide.
Yeah, I think this is a very valid point, and I think absolutely right. I mean, there's always been a question as to whether the safety is is about USD or UST, right? U.S. Treasuries versus U.S. dollars, and I think the work of people like Arvind Krishnamurthy and Anno Lustig and others concludes that a lot of it is USD. It's the dollars, maybe more than the U.S. Treasuries, and so you could imagine that you would have other safe asset issuers, then of course, then the question is how safe, would be able to come into that space and then issue dollar assets. Now, I think we want to be a little bit careful. We had an earlier episode of that in the run-up to the global financial crisis, where there were, the AAA tranche of the collateralized mortgage obligations was supposed to be safe assets. And they weren't quite. So then there's a question about whether the private sector can securitize this type of instruments, or whether these are other public issuers. It's a broader space, and I think that space can be populated as well.
Thank you. I don't actually see any more hands. So we are out of time as well. Thank you once again, Pierre-Olivier. And thank you as well to participants who joined us online.